means anything because this is just going to cause you to be wrong on your bias and lose trades. Instead, I want you to pay attention to these three levels in fair value gaps in order to execute and evaluate price action correctly. So the key level number one we're going to be talking about is going to be the fair value gap open. So if we are looking at a fair value gap, the open is going to be at the bottom of a bearish fair value gap, or it's going to be at the top of a bullish fair value gap. It's just going to be wherever the beginning of the fair value gap is the first area that price will trade into when it hits it. Key level number two is going to be the fill of the fair value gaps. So this is going to be the opposite end of the fair value gap from where the fair value gap begins. So for example, in a bearish fair value gap, here is the open, and the fill is going to be up here. The third key level is going to be the midpoint of the fair value gap. Now, midpoint can be found by using a fib tool. You go right up here to the left, and you need to have these settings right here. You can make whatever color you want, but 1, 0, and 0.5 are the settings you need. But I want to be very clear that just understanding these levels alone means nothing if you don't have a set of rules on how to use them consistently. So here are the 3 rules on how to use these levels for fair value gaps for bias. Rule number 1 is that if price taps into the fair value gap and fails to close beyond the midpoint, then it is valid, right? So we see right here, the price taps up into it. It does not matter how far the wick goes. The wick could go even out of the fair value gap. As long as the candle body is not closing beyond this line, the fair value gap is valid. Now in step 3, after we go over these next couple rules, I'm going to show you exactly how we're going to use this in a mechanical strategy to get an 80% success rate on daily bias. So you can see again, price travels up into this fair value gap. It fails to close above the midpoint and price falls. Both times this happened, price fell. Rule number 2 is that if price closes beyond the midpoint, it is invalid. Now this just means you're going to wait for the next fair value gap. So if you see right here, price came down into this fair value gap and it closed beyond the midpoint, right? So at that time, we would have just waited for the next fair value gap to use this strategy to find bias. So right after that, the price tapped into this level up here, and then it went to the downside. So if this happens, you're just sitting on your hands and waiting for the next high probability situation. And this is how we keep such a high win rate. Rule number 3 is that if price closes through the fair value gap, this is an inversion. As you can see right here, after the market closed through this fair value gap, we can then extend out this level and watch how price reacts. And you see, price came up, it could not close above that midpoint with this candle right here, and then price traded to the downside. And again, over here we have a fair value gap. So when the market came down in here the first time and it failed to close, you can see that if you were a buyer on this day, or this day, you would have been successful. And the same goes for this day, which is going to be almost every single day except this one day. Because if you're trading ICT, you should be getting in on the wick of the candle, meaning that any of these days except this candle would have been a winning day. And then this candle closes beyond the midpoint, so now you are waiting for price to trade into the next fair value gap. And what happens is it inverts this fair value gap, and then it starts trading down to the lows. Now, we're going to go over this mechanical strategy on exactly how to use this in order to find daily bias in the live markets and go over some live examples. But I want to be very clear that as with any ICT strategy, this is completely useless unless you have a plan for action. So what I want you to do is download the free PDF guide on this strategy by clicking the link in the description. This video is helpful, but it's going to be a lot easier to keep the PDF in front of you while you're trading instead of trying to rewatch the video while the live market's going on, and that way you'll be able to effectively use the strategy. Now, let's go ahead and get started on step 3, which is the 3 steps on how to put this together in a mechanical way to establish bias and find your draw on liquidity. Okay, so now let's get started on the 3 steps on actually putting this together for your strategy. So 1 is you're going to head to the daily chart. You're going to wait for a fair value gap to form, and you're going to watch for the most recent tap. So we're going to mark out this fair value gap right here. Okay, so step 2 is we're going to wait and evaluate the reaction using the 4 rules that we went over in step 2 of the video, right? To see if price is bullish or bearish. So remember, if price closes beyond the midpoint, meaning it closes beyond this 0.5, then it is invalid. Now that doesn't mean we're going to immediately short this to the low. We need an inversion to do that, okay? So right here, it's invalid. We are just looking at this as a no trade scenario, okay? So what we're going to wait for is, let's see what happens with the market here. Does it invert? So we're going to wait. Okay, now the market has inverted, okay? So now we have traded outside and closed outside of this fair value gap. So what we're going to be doing at this time is now we're targeting out this low. And if you want to use a little discretion with this, we know that there's going to be a lot of liquidity under this clear, clean low. But For the strategy to be mechanical, you can just target the next low. So that would give you a bearish draw on liquidity from this day. You would have been selling the market all the way down into this low, because that is step 3, which is to target the next fair value gap or the next liquidity in the direction of your bias for your draw on liquidity. Okay. On all these days, you would have been selling, and you would have been selling very successfully. So let's wait and let's see what happens next. So the market pops up. So the market's now created another couple fair value gaps. So you want to map these out. Now, I want to be clear, you don't have to map all of this out on your chart. You don't have to have a bunch of fib tools all the time while you're trading. This is just for the sake of education. And another thing I want to be clear on is that until the market has proved that it's changed bias. So for example, right here, we close down under this low, and you can use the first video in this series, which is a series of 5 videos that will teach you everything you need to know in order to be profitable with ICT. But you can use impulse structure, like we talked about, where we've displaced through these lows to tell you, along with the fact that we haven't invalidated this bearish order flow, which is our fair value gap, that the market's still bearish. So you can maintain that bearish bias until proven otherwise, okay? The market keeps going down, and now we're failing to displace. Again, this is going to be in the first video of this series, so if you haven't watched that, go watch it. Now the market's failed to displace. It's going to pop up to this high, and then now we trade into this fair value gap, okay? Let's see what happens next. So since the market is failing to close beyond this 0.5, that helps us keep our bearish bias, and it's going to give us a draw on liquidity of this low. But if you're using your overall discretion, you can look for a bearish bias. Remember, if this doesn't get inverse, right? So then the market comes down and it displaces through this low, and it trades all the way down. So if you are using just this simple strategy, you're going to be able to have a bearish bias all the way from here. So it's going to be 1, 2, 3, 4, 5, 6, 7, 8 trading days. 6 of those you were trading with successfully, right? Because you had a bearish bias. Now, on these days, if you had a bearish bias, there probably wasn't a ton of selling opportunities. So you would have been sitting out and been on the right side of the market. This is paramount whenever it comes to long-term success as an ICT trader. So next we see we have tapped into this fair value gap. We have failed to close above it. So what is that going to give us a target of? It's going to be this low right here, okay? So then what happens? The market trades straight to that low and displaces through it, right? So until we start inverting any fair value gaps on the bullish side, we are still going to be bearish. So you're selling on this day, selling on this day, selling on this day. I mean, you can see how consistent this really is. And it's also extremely simple. Okay, so now we have this right here, which is our next fair value gap. Let's see. On this day, you may have had one losing day because the market ended up inverting this fair value gap. So what does that do? It gives us a next target, and that's going to push us up towards this high, right? Because the market's bullish. We're now trading and targeting buy-side liquidity. So the market comes up. It also inverts this fair value gap, which just gives us a support level if the market does trade back down into it. But it doesn't. It trades and displaces through this high. And what it does again is it inverts this fair value gap. So what does that do? It gives us a bullish target. Now, again, keeping it mechanical, you can just target the next high. Or if you're using some discretion, we know that the liquidity is going to reside above clean highs like this. Then the market trades pretty much straight to it. It gets one more fair value gap tap. And remember, until the market proves that it's bearish, meaning since we inverted this fair value gap on the bullish side, we're going to go ahead and expect any of these bullish fair value gaps to be respected. And it does get respected right here. We fail to close at the midpoint. So on this day, if you're a buyer, boom, we trade into these highs. Okay. Now, if we trade into these highs and we're bullish, the next target is going to be a fair value gap. So this gives you your next draw on liquidity. And you can see the market trades right through that. And there you have it. It's extremely simple. And this is something that many of you guys will benefit heavily from. So if you guys know my channel or know me, then you already know that what I do is I simplify ICT into a point where you can actually make money. Because the problem with ICT for a lot of people is that it's so complicated and there's 1,000 different concepts that you learn all of these different tools and you're overwhelmed and you get something called paralysis by analysis, right? But if that's how you're feeling, it's okay. It's normal. Everybody goes through it. I went through it before I became successful, okay? That's totally normal. Don't beat yourself up for it. But what I want you to do is I want you to make a promise to yourself to use more simplified strategies, right? Use stuff that you can actually take action on. That way you can see success like you're seeing everybody make money on social media and you're not making money. It's just because you're sitting here trying to learn 1,000 different things at once. So I want you guys to make some promises to yourself to take action to simplify your strategy. If you need help doing that, I have a ton of videos for free on YouTube on how to do it. They're all called Simple ICT Strategies. I have a whole playlist. And on top of that, I want you to watch the first video in this series, and I want you to watch every other video that's going to be coming out in this series, because it is the 5 steps in order to become successful with ICT, all for free on YouTube. So if you made it this far, I want to thank you for watching. I also want to ask you to subscribe to the video, because again, I put out a lot of simple stuff for free that's helped a ton of people. And I also want you to go down to the description and download the PDF. Again, I want you guys to study this video. I want you to study it in ebook format. I want you to keep the PDF strategy right in front of you while you're trading. That way you take the guesswork out of bias and you're able to simplify your strategy. Now, there is a step 4 to the strategy, which is more for intraday traders, and that is only found in the PDF. So make sure, again, to download it. It's really good for intraday traders. But again, thank you for watching, and please subscribe to the video. And always remember that if you can't see the liquidity, then you are the liquidity.